Hello everyone, this is John Locke and I'd like to welcome you to The Winning Trade, but first the required disclaimer material. This presentation is given for educational purposes only, and we're not broker-dealers or financial advisors, and we're not making any specific trade recommendations. Also, please be aware that your risk in trading options is substantial, and please make sure you're aware of all your risks prior to placing any trades. Also note that the trades in this presentation are hypothetical computer simulated trades. They're believed to be as accurately represented as possible. Keep in mind that live results can vary from simulated results for many different reasons. If this is your first experience with us, my name is John Locke. I'm a trading performance, wealth, and success coach with Locke in Your Success LLC, where myself and my team of mentors are here to help you win in the markets and in life as well. And today, I'm here to take you into the realm of high probability options trading, also known as income trading. This is where we utilize option strategies to make money from the passage of time rather than depending solely on price movement in order to make money. Now, this means that we can make money or often make money whether the market goes up, down, or sideways. This doesn't mean we're going to win all the time, but it does mean that we're more likely to win than we would be if we were simply trading directionally. Now, the trading strategy I'd like to share with you today is called the super simple bearish butterfly, also known as the bear. This is a complex options trading strategy that we trade on the Russell 2000, and it takes advantage of a variety of markets, such as overextended uptrending markets, volatile and very volatile sideways markets, as well as volatile downtrending markets. And it'll also tend to do well in smooth trending down markets as well. If you haven't been paying attention, we are currently in a very volatile sideways to downtrending market right now, and the bear strategy is a simple strategy that performs well in this type of market. Now, the bear strategy requires a minimum of $5,000 capital in order to trade, and it has a profit target of 30% or $1,500 and an exit loss trigger of 30% or $1,500 if you're doing the trade the minimum size. The trade example we're going to be doing today is going to be the minimum size, and it's going to be a $5,000 planned capital trade. So what we have here is a option analytical software called Optionnet Explorer, and what this software does is it shows us the risk graph of the position that we have on. Now, if we buy stock, it's pretty simple what your risk graph is. If you buy 100 shares of stock and the stock goes up $1, you make $1. If the stock goes down $1, you lose $1. Here, we start doing complex option strategies. It gets a little more complicated than that. And this analytical graph shows us what that is. So just a quick view of what's going on here is we have the date. So this strategy starts on, or this particular trade starts on Friday, March 25th, 2002. And this here, along the columns, along the top here are our expiration cycles. We're choosing an expiration cycle that is 56 days to expiration. In this case, it's the May 20th, 2022 expiration cycle. We have our call options on the top. We have our put options on the bottom. And we have the strikes. We have our mid prices for each option. We have the implied volatility for each option, the delta of each option, and the position that we have on. So in this case here, what we're going to do with the bear trade is we're going to come in 56 days to expiration, and we're going to sell 2 put options that are approximately 20 points under the money. So the asset price right here is $2,068. That being the case, our closest strike would be 2070, and we're going to sell the 2050 put options, and then we're going to use 50-point wings. So we're going to go 50 points higher to the 2100 put options and 50 points lower to the 2000 put options, and we're going to buy those. And we're going to do this in one order. So if you're trading options or any kind of complex option spreads, you should have a broker that will do complex options orders in one order. And what we will do is we'll buy a butterfly. We're going to buy a butterfly with the short strikes of 2050 in this case, 2100, a long strike of 2100, long strike of 2000. And once we do that, we come over here to our analytical graph, and this is what our analytical graph looks like. Now, on our analytical graph, we have our asset price across the bottom. We have our profit and loss along the left side here. And we have this sharp edge blue line, which is what the profit and loss of this position is going to be at any given price point when the asset expires. So if the asset happened to expire at 2050 and we stayed into this position till expiration, then we would make $4,500. If it expired, outside on these flat areas here, we would lose $500, which is also the actual risk in the trade, by the way. The actual risk in the trade is $500. We have a planned capital because that planned capital number doesn't represent what's in the trade at the time. It represents a number or an amount of capital that we won't go over or we will not exceed during the trade. And as we make adjustments and so forth, we can increase capital. Now, in the current market environment, we're not getting anywhere near $5,000 in the trade. We'd be lucky to get much more than $1,500 or maybe $2,000 in the trade. We'll see what this one comes out at, but that's what we have in the environment, meaning our yield is actually much higher than what we're showing because we're figuring our yield off planned capital regardless of how much capital we actually have in the position. Okay, the other line that we have here on our position is this curved line is called a T+0 line, which shows us the value of our position at any given price point as of today. And of course, this is a projected and estimated value, but the software is projecting that if we went to 2200 today, that we would be drawn down $210. And if we went all the way back to, say, 1950, we'd be up about $52. So what we're going to do is we're going to hit this forward from day to day, and we're going to skip some days, but we'll show you how this trade progresses. Basically, over time, what tends to happen is this T+0 line will eventually match the expiration line if we take this all the way into expiration, but it gets there gradually, and that's where money comes in. So the question becomes, how are we going to handle this trade if the price moves? Well, if it moves outside of our tent, so we call this the tent. If it moves outside of our tent here, or if it moves to certain levels in relation to the tent, we're going to be making adjustments. So we have short strikes at 2050, and the way that this works is to the upside. In other words, if the price goes up in the asset, we add into the position. So if the price goes up to 2090, which is 2050 plus 40, if the price goes 40 points over our short strikes, we're going to add another butterfly at 2070 here. And then if the price goes up to 2110, we're going to add another butterfly at 2090. And then if the price continues to go higher than that, we're going to start what we call rolling butterflies. We'll pull off the lower butterfly and we'll move that butterfly up higher. To the downside, we allow this to the point where it gets into trouble to the downside. And with the bear trade, if we get into trouble to the downside, you know what? We just exit. And usually, by the time we do get into trouble to the downside, we're going to be up money. Okay? Like I said, this strategy works extremely well in choppy markets and downtrending markets like we're in today. So let's move forward here and show you the trade. So just 2 days into this position, and I'll show you the price chart here. So we entered the position down in here, and we ended up getting, on this day, we ended up getting a 59-point up move in the Russell, which is huge, by the way. And historically, those types of moves don't happen very often, but this is the direction we like the position to go in, because we want to get scaled into the position. So if you remember, we had a short strike of 2050. We have an add when the market gets to 2090. We have another add when it gets to 2110. From there, when the market gets to 2120, we have a roll. So we have 2 adds in one roll, and then 2130, we have another roll. So we have 2 adds in 2 rolls. So if I was to add a butterfly, I would have added the first one here. I would have added the second one here. The third one, we would have rolled to here. On the first roll, we would have rolled to here on the second roll. That means that our short strikes should be at 2130, 2110, and 2090. So one of the things about this position is we're not checking it during the day. We're only checking it once per day. And we're going to come in, and what happened here is, the day before, we were here. Let's go the day before. Day before we were here, we didn't trigger any adjustments. Then we got this huge up move in the Russell the following day, and we triggered 2 adds and 2 rolls. Okay, so here I am, end of day. I calculate just like I did where my position should be. I remove this butterfly here at 2050, and then I'm gonna skip the ads, and I'm just gonna put the butterflies where they belong, which is 2130, 2110, and 2090. So if I uncheck this, this is where we should be. 2130, 2110, 2090. So I would have put an order in to sell the previous butterfly. Then I would have put an order in to buy a 50-point wing butterfly at 2090, buy one at 2110, buy one at 2130. And this is going to be our position based on that adjustment. Okay, so you see our position's much larger. Our total capital in the position now, and I'm going to keep track of this because I'm kind of curious what the actual return on invested capital is. So we actually have $1,725 in the position right now. So let's move forward here. We end up getting a 43-point down move, another 14-point down move, and here we are with a 13-point out move. So 3 days have gone by, and we're up $143. Now, a lot of income strategies, if you enter the strategy and you enter at negative delta, it's going to draw down when the price goes up, and then, or if you enter at flat delta, sometimes you'll draw down when the price goes up, and then if you have to make up adjustments when you're drawn down and you get this pullback, then a lot of times these are underwater. But one of the things I love about the bear trade, when you get this choppy back and forth market, it tends to do really, really well. Let's run a few more days here. We're up 213. Now we get a pull back into here, and we're up $403. Again, our profit target here is 1,500, and if we stay, if the market ranges out for a while and behaves, chances are fairly decent that we can get up to 1,500. Remember, we entered 56 days to expiration. We actually exited this trade 21 days to expiration, regardless. So we still have plenty of time here to make that kind of profit. If the market doesn't behave at this point to the downside, we're just going to exit. So what we're going to start doing here is once we get to a certain positive delta, we're going to start exiting out of our upper butterflies that we added. So here, if we go to the 6th, we end up with a 32-point down move. So what happens is we get down here and our delta is too positive for our position. So what we're going to do is we're going to pull out of our upper two butterflies here. We're just going to sell those off. And we're going back to 1/3 of a position. And now we only have about $330 in the position at this point. So our risk is, has been maintained very low. Remember, the position has an exit loss trigger of $1,500, and we only ever got $1,700 in it. So the chances of hitting that in this case would have been extremely unlikely. So if we continue to go here to April 7th, actually, hold on, I may have closed it the previous day. Let me look at my T-log here. Yeah, okay. So what happened is I pulled out of my two upper positions here at 1530, and I was still positive delta. So what ended up happening here is I pulled down my two positions, and the exit rule for this, if I'm positive delta and I'm more than 10 points past my lower long, so here we can notice our asset price is 2013, our lower long is 2040. If I'm more than 10 points past that, which I am, and I'm positive delta, then this position is exited. So basically what happened is we entered the position, we got this big up pop, we got scaled in, which is what we want to do, and then we got whipsawed to the downside. And this position here being a protection type of strategy to the downside, if the market whipsaws too hard as it did here, what happens is we pull out of the trade and we exit at our profit, in this case of $358. So if I do my math here, that would be a 7.1% on our planned capital of $5,000. And if I take a look at our actual capital in the position, let's see, we're $358 profit divided by 1725. That gives us a 20.7% return in the trade. And this is why I love the bear trade, because it's a very simple strategy that takes advantage of very volatile, choppy markets, especially when they're downtrending. And I love how this strategy has performed this year. For those of you interested in the rules of the bear strategy is a trade that is included in our Go membership. So all you need to do is go in and sign up for our Go membership, and then we'd be able to get access to this, along with many other benefits and past recordings. And that is the bear trade, this episode's winning trade. If you like what you see, I invite you to come over and check out our Go membership and discover how you too can follow along with this and many other great strategies as they unfold during our weekly options trading for income update webinars. Also, where you can learn about upcoming winning trade presentations, explore past winning trades, and receive access to free bonus material and other information regarding the winning trade. Also, perhaps best of all, you can check out our free Trading Performance podcast, where you can learn to skyrocket your trading results regardless of the type of trading you do. If you have any questions, comments, or anything else you'd like to see on the next winning trade, please comment in the video below, and I'll make sure I answer your questions for you personally. Again, to find out more about me and our company, come on over to lockinyoursuccess.com. That's LOCKE in yoursuccess.com, or thewinningtrade.com. That's thewinningtrade.com. And check out the many exciting offerings that we have. Thank you for joining me, and I look forward to seeing you on the next winning trade.